So at Lighthouse, we have offer a wide range of services. So we've got accountants, mortgage brokers, wealth advisors, and insurance advisors. Our mission as a business, though, is to help secure Kiwis' financial future. So we don't talk a lot about money in this country. And money doesn't necessarily buy happiness, but it's certainly hard to have peace of mind if you're not on track with your money. So we believe education, which is what today's all about, what our podcast is all about, plus taking action equals financial freedom. Mike, sometimes people think they listen to a webinar and they're sorted, but it's the action piece off the back of it, isn't it?
Yeah, absolutely. And what you'll hear today is us really stress around trying to get you guys to take action. And whether that's with us, by yourself, with your partner, whatever, that's what we're really trying to stress, is that earlier you take action, the less sacrifices you have to make, the more options you have generally, the better you'll be financially.
Yeah. And we're not saying shoot from the hip, well thought out decisions, making sure we understand risks. But yeah, definitely want to get the show on the road. Next slide, please, Ravi. Okay, this is our sort of validation slide. So we've done a lot of these webinars with a lot of big businesses, took about 5,000 people through them last year and have had very good feedback. The way we usually do these webinars is Mike and I talk for about half an hour. We got some new slides to talk through. It's our first webinar of the year, so we're a little bit excited. And then just ask questions as we go. Now, if we've got a room full of people, Ravi's in the background. Our marketing manager pretty much organizes everything for us. Ravi, we just might want to think about how we do the Q&A as well. I'll let you work that out.
Yeah. Cool. So our disclaimer. So both James and I are financial advisors. So we will try and give you as much information as possible and as much advice. However, you've just got to remember that this isn't personalized advice. This isn't tailored to your situation. We're really just talking in general terms here. There will be the option to book some time with us later. If you do want to discuss your personal situation, feel free to do that. The thing that James hasn't really mentioned yet is that both James and I love the Q&A section. That's where people get the most value out of this, really. If you've got questions, just start firing them away. James and I will try and answer as much as we can. However, if you ask a question and it's, I'm 30, my partner's 32, I earn X, they earn Y, should I buy an investment property and how much can I borrow, or what stock should I invest in, or something like that, that's personalized advice. We just can't do that on this webinar.
Cool. Ravi, maybe we'll just take them off mute at the end and they can just ask questions.
Yeah.
So what have we got on the agenda today?
What are we going to talk about today? So our discussion points, we're going to give a quick market update. There is a lot of chat in the media, in the news at the moment about the market, inflation, interest rates, recessions, people getting laid off, all of these sorts of things. So we'll give a quick sort of update on where we think the market is at. We'll cover off some of those key points around inflation, interest rates, how they're related, what history shows us a little bit, because people tend to panic with big movements in interest rates. And then we'll get into the sort of the nitty gritty of what should you actually do? What are some useful tips and how you can sort of balance out your finances during this time? And then our favorite bit, Q&A.
Nice. So 2022 was a year that had been coming for a while. In 2020 and 2021, obviously COVID hit, people worried about a recession happening. So what did we do? We created an artificial sugar high, dropped interest rates, luxury spas sold out, luxury cars sold out. Everybody was going to buy houses, upgrade, buy investment properties. And then suddenly we realized there was no free lunches. So inflation went through the roof. It was like a 30-year high. The share market dropped by about 20%. The property market, depending on where you are, is down somewhere between 10 and 20%. So it wasn't the most fun year, would you say, Mike?
No, it's not. And all of the indicators for this year suggest actually it may not be much better. However, that is just the market. That doesn't mean that you should be reserved during the market or put your head in the sand or do nothing. With volatility, with ups and downs and these sorts of things also creates opportunity. So actually, it could be a really good time to make some moves if you can sort of afford it.
One thing that doesn't help, Ravi, if we just jump back to the previous slide, one thing that doesn't help in a crappy year is when the media is just telling you the world is going to end every freaking day of the year. Yeah. And then it does create that kind of anxiety, that panic. What should I be doing? Everybody's got an opinion on where interest rates are going and that nobody's going to have a job and all of these sort of things. The main thing I would say on this kind of point of what's happening in the market is the last time we had a significant drop in values and real uncertainty was 2008. That was 14 years ago, which is a really, really long time between drinks for a bad year. We had a incredibly good run with the market and what was happening. And good times will always come back. And this is where Mike said right at the start, there is, if you can remove, have a plan, understand what to do, there's great opportunities at the moment with essentially everything being on discount.
Yeah.
Here's probably a pretty good indicator of, we talk about whether we like the slide or not. Warren Buffett has an expression of be fearful when others are greedy and be greedy when others are fearful. And that's pretty much saying that as everyone's chasing the end of the bull market because all their friends are doing it, probably not the best time to be doing it and probably reflective of that tough times are coming. But Mike, it's really hard when everybody's running in the opposite direction. Everybody's being quite emotional. Interest rates are really high. You never know when the bottom's going to be that brave person that kind of takes those steps forward, isn't it?
Yeah, and we see this really commonly with property, right? At the peak of the property spike, sort of November 2021, every single person wanted an investment property, wanted to upgrade, wanted another property, all of these sorts of things. Now that it's come back between sort of 18 and 20%, depending on where you are, between 8 and 20%, depending on where you are, everyone's really fearful. Everyone's like, oh no, I'll wait it out, see what happens. Actually, now would be a significantly better time to buy if you could afford it than at the peak because you're getting things on a discount. So what you'll see here is just some sort of stats around the average house price in New Zealand. And yep, it's down 8.2% since this time last year, 10.2% since the start of 2022. Now, if you have a house and you are watching the value of your house go down, it is a really scary thing, right? Because you're like, I had all this wealth and now it just keeps getting eaten away. Yep, absolutely. That is a paper value for your house. If you don't sell your house, you don't crystallize that loss. And over the long term, we know that the property market in New Zealand runs at about a 5% growth rate per annum. So it will come back eventually. What I'm sort of saying is, you know, just because the loss of wealth is a bit sort of scary to look at, just because the media is saying it's going to be a terrible year and all these sorts of things, if you do the math and you can afford it, now might be the time to make some moves and get out there and think, actually, I could grow quite a bit of wealth at the moment.
The other thing I'm just looking at that slide, Mike, is see where it says 1 year, which is on at the moment, and then there's 5 year, the next one across. It would look obviously a dramatically different graph if you had more time to see what happens over market cycles.
Yeah. And just quickly, the one thing I want to say here is I'm not banging on about telling everyone to go out and buy houses. That's not what I'm doing at all. What I'm trying to convey is just because investor sentiment is down, just because the market is down, doesn't mean that you have to not make any moves. Again, now is the time where people build a lot of wealth when things are on discount. So
just before you jump into it, Mike, as well, in terms of the talking about property, we will talk about a lot of other things as well. But obviously how much interest rates have gone up, which Mike will talk about in a second, it's a big stress point for a lot of people this year.
Yeah. And here's a really good sort of example of what that looks like, right? And, you know, let's say $1 million loan, you took it in 2020, you got one of those sugar high interest rates of 2.5%, which by the way, is not a normal interest rate for New Zealand. Your weekly payment, $911. Yeah, pretty manageable. 2023, if you're rolling off that 2.5% and you're rolling on to your average 2-year fix in the market around 6.74, your weekly payments are going to be $1,494. So that is a huge jump in terms of the cash flow impact on the household. Now, we've got here how much interest you're going to pay over time on a 30-year mortgage and these sorts of things. Look, you don't get 2.5% for 30 years and you won't get 6.74% for 30 years. you'll get a blended interest rate as interest rates go up and down in the market. But what this sort of means is, if you are rolling off one of these low interest rates in the next sort of 3 or 4 months, which 50% of ANZ's loan book is, and 40% of ASB's loan book is, so pretty much call it half the country is rolling off a low interest rate, you need to have a look at the numbers and think, okay, do I need to do something here? Do I need to adjust the budget? Is there something I could do with my loan to sort of decrease the cash flow impact if it's not sustainable? And remember, these interest rates won't last. We saw interest rate pricing from ASB the other day that sort of suggests interest rates will start to come back around the 18 months to 2 year mark. But the earlier you take action, the easier it will be to adjust your loans to try and mitigate some of the cash flow impact.
Yeah, and just it's important, while this is scary, not to have your head in the sand. And Mike will talk you through in a little bit later, like different options and different things you can do. Having a conversation, going, what are my options? How do I plan for this? It's much better to plan than just be hit by it one day.
Oh, yeah.
Okay, so the property market is back quite a bit. And as I mentioned before, the share market has really struggled over the past 12 months as well. And you will have seen that in your Kiwi savers. The good thing when it comes to your Kiwi savers is hopefully you are all contributing. So while it is down, that says 8%, it's probably a bigger number than that. While your Kiwi saver is down over the past 12 months, you are regularly contributing, you are buying at a discount, which if you can buy something at a discount and you're a long-term investor, it's a great opportunity. But essentially the problems that we're feeling here in New Zealand are no different to the rest of the world. Inflation rates are really, really high, which means that investors, instead of investing into the share market, are going, maybe I'll put some money over into bonds, or maybe now's not a good time to be investing at all. I'm going to sit on my hands. One of the big things that will swing with the share market, and I think the share market will move quite a bit earlier than the property market, in my opinion, is that when inflation starts to not even pull back, but starts to balance out, which there's already been some indication in the States around that, the market will go again. The average kind of down market for the share market lasts usually about 9 months, and there's been scenarios where it's been like a month and then years. We're probably 12 months into that now. I think, like Mike alluded to with interest rates, I think on the share side, probably another 6 months away before we see some movement, but inflation's the bigger pillar there.
Yeah. Cool. So what I'm going to do now is just run through a quick sort of description of what inflation is, why it's sort of important to consider, and then how it impacts you on a day-to-day basis. So inflation is the general rise in the price of goods and services in an economy. It's tracked using the CPI index or the CPI basket, which is just a general basket of goods that people might use on an annual basis. And they just track how much is the price increasing of this basket of goods per year. Now, some inflation in an economy is a good thing. The Reserve Bank is targeted with keeping it between, I think, 1% and 3% at the moment. Having a little bit of inflation encourages people to spend. It means that people don't just sit on all of their money. It promotes sort of a bit of transaction volume in the market. So that is a good thing. When it becomes a bad thing is when inflation sort of gets out of control or starts to be, too much for the economy to handle, which is really what we're seeing a little bit now. So let's have a quick look at inflation history. So you can see here that, to be honest, it's all over the show. The Reserve Bank in 1989 was targeted with keeping inflation under control, and their inflation target was between 0% and 2%. That was updated in 2002 to 1% and 3%. So the Reserve Bank of New Zealand's primary job is to keep inflation between 1% and 3%. Recently, it's been as high as sort of 6%, 7%, way outside of that 1% and 3% bound. And what that means is that prices are rising too fast in the economy. People will stop spending because they don't have confidence, and just people's wages can't keep up. So it's really retractionary for the economy. Now, Inflation, great. Economic term. What does this actually mean for me? Well, the Reserve Bank of New Zealand's primary tool for controlling inflation is the official cash rate, which leads into the interest rates, well, the market interest rates that you get on your loan. So what will happen is if the inflation in the economy is too high, the Reserve Bank will raise their official cash rate. This will mean that through a couple of mechanisms, the banks in New Zealand will generally raise their mortgage rates. That directly impacts consumers in the economy by taking money out of their pocket. If you're spending more money on your mortgage, you have less money to go out and spend in the economy, it will dampen demand, and that will mean that inflation should come back a bit. This is really the primary and one of the only tools that they have. So what you've seen recently is because inflation has been as high as sort of 7%, the Reserve Bank has really ratcheted up interest rates quite quickly. And that's why you've seen that spike of just going from sort of 2.5% all the way up to sort of 6 and 7%. Now, if we look at the history of interest rates in New Zealand, again, a little bit all over the show. Around that sort of 2007, 2008 mark, they were quite high. As the global financial crisis happened, they dropped off a cliff. And then what you'll see around that 2020, 2021 sort of time period is when COVID hit, the Reserve Bank lowered the price of money significantly. And that was to stimulate the economy and avoid it falling into a recession or a depression. Arguably, they did that too much and did a couple of other things, and price inflation in the economy absolutely boomed. And this just wasn't in New Zealand, this is globally as well. So now you can see a really steep increase there where we're going from 2% all the way up to sort of 5, 6, 7%. And it's likely to increase a bit further as, just to make sure that inflation really does come out of the economy.
It's a nice reminder and easy to forget that, and when you look at it over that period of time, just how low interest rates got. And then it kind of makes me think of, everybody's got a great Auntie Gertrude who was like, the first loan on my house was 20%. Yeah. I was like, yeah, but you spent 2 shillings on the property, right?
Yeah, exactly. The other sort of, I guess, key thing to look at here is 2% is not a normal interest rate for New Zealand. It is way too low. And you can see that when we have 20% house price increases per year. That's not sustainable. So there's a little bit of normalization of interest rates here, but it's just happening really quickly to pull that inflation out of the economy.
Yeah, my question for you, the expression like I pick a recession over high inflation every day of the week.
Yep.
Why is, because I guess the other point that probably the average punter is thinking about is like, why the hell's everybody doing this to me? I got like bills to pay as it is. Why do we pick a recession over high inflation?
Yeah, cool. So any day of the week, you would pick a recession over rampant or hyperinflation in the economy. It is much easier for an economy to come back from a recession than it is for an economy to come back from hyperinflation or rampant inflation. If you look at the extreme examples of Zimbabwe, Venezuela, I think post-Germany, World War II, and East Germany with the mark, 1,000% per month inflation is the risk, and the whole economy has to reset. So you effectively throw out your currency, and those are probably 1,000% per month inflation is probably a little bit light. Like in some instances in Zimbabwe, money was, as you could not print it fast enough for it to be valuable. So there's the extreme end of what hyperinflation looks like. But actually, even if you pull it back, quite a bit from there, it is absolutely devastating for an economy. And you almost, again, have to throw out your currency, restart or repeg your currency to the US dollar just to get the inflation under control in the economy. So all day long, someone's going to lose their job, someone's going to have to sell their house. But that is a really minor impact if you look at the other end of the spectrum and look at hyperinflation.
Cool.
Doesn't make it any personal, but yeah.
Yeah, you sound heartless. If we look at the other end of the spectrum, so we spent a bit of time talking about property, interest rates, inflation so far. With the rise of the Sharesies platform in particular, there's lots of really good things about DIY investing and direct investing. Accessibility of the market's been really good. usually I would say fees have dropped for investors, although Sharesies have just increased their fees like 400%. So got to be careful of that one. But it means that essentially there's a whole market available to invest into. Now, everybody has their assets they like to invest into. Obviously, a lot of Kiwis love property. You've got those that love gold. There's the share market, there's emerging markets, there's sitting in cash, there's bonds, there's a whole range of things. This slide here is pretty much saying, tell me the trend. If you look at the top, it's the best performing asset. If you look down the bottom, there's the worst performing asset. Gold was the top performer in 2010 with a 29% increase. In 2013, it dropped 27%. It's really, really hard to pick the market in terms of what assets will perform well. In 2020, the New Zealand share market stayed flat and the US share market moved 20%. So diversification is king, having exposure to, and you don't, it really depends on somebody's situation. You might not, from like day one in your life, have a diversified approach. You might concentrate your wealth with one or two avenues and diversify later on as you built wealth, or you reduce your debt, or whatever it might be. But this slide here is pretty much going, there is no trend, there's no asset better than the others. It's just a diversified approach, and having your eggs spread across lots of different baskets is the best way.
Yeah, and to come back to the Sharesies piece, we love the fact that it promotes people getting involved in finance and thinking about their finances and how they can grow their wealth. But to be honest, guys, it's just gambling. Like, there are people who have as entire jobs are to sit down every day and figure out who to invest in, how much to invest, what company, what market, what type of investment. Is it an iron butterfly spread? Is it, an iceberg sale? They still get it wrong. So I don't see, everyone sort of wants to be really active in picking their stocks. What is the stat, James? Like 3% of Sharesies accounts make any money?
4%.
Yeah, it's just gambling.
Yeah. So the other thing which links back to what we were talking about before in terms of having a long-term approach and sticking to a plan is there's quite a few different ways to invest. So there was a study done in 2021 where you had $2,000 at the beginning of each year from the year 2000 to the year 2020 to invest. And there was different approaches to how they invest. So we've got 5 different approaches. Mike, let's go one for one to have a bit of fun. I'll kick it off with Peter Perfect. So Peter is your guy. Like, if you talk about people sitting down and working out the best thing to do, picking the best day of the year each year for 20 years in a row, it's impossible, but somehow he's done it. So pretty much the lowest price in each year he's worked out. That's when I'm investing my $2,000 a year.
Yeah. Next one is Ashley Action. So, she thought, I'm never going to be able to be Peter Perfect. What I'm going to do is just throw my 2,000 in the market on the first trading day of the year. Let's get it over and done with. I don't have to think about it.
Cool. The nerdy accountant, Matthew Monthly, has divided his annual contributions by 12 and is putting $2,000 in a year in equal portions. This is what we call dollar cost averaging. So first of every month, $2,000 divided by 12 goes in.
Yeah. Next one, Rosie Rodden. So look, guys, she had the worst timing, the opposite of Peter Perfect. So invested her $2,000 each year at the worst day to invest. Now, this is equally as impossible to do as Peter Perfect, but for illustrative purposes, she's the worst one out of the lot.
And then Larry Linger is too busy and then also reckons the market's going to drop some more. So old mate Larry sits on his hands and keeps his money in cash for the 20 years, thinking there's always going to be a better day to do it.
Yeah.
So the results. So unsurprisingly, Peter Perfect is the best because he's picked the best day 20 years in a row. He's got $150,000 in 20 years' time. If you look at investing immediately, Ashley Action and Matthew Monthly, very similar outcomes, about $15,000 behind. The interesting one is Rosie. So Rosie's picked the worst day each year for 20 years, yet She's only $30,000 behind Peter Perfect. So it's the whole thing about going, and I think I heard this maybe from Tony Alexander, that in 1987, when your parents were buying their first home, do you think they thought house prices are $87,000, but I think they might drop to $86,000? Completely irrelevant now. And it's the same thing with Rosie Rotten. While when she invested in that year, it was a bad year. In 20 years' time, that was a phenomenal year to invest because the market's gone up 10% each year. But Mike, the people we are trying to save are the Larry Lingers of the world, the ones that stay in cash, do nothing, and their money ends up being a third of everybody else's. And it is very hard to outsave bad investment decisions.
Yeah. And again, this is what we're stressing here, is not you have to be Warren Buffett, Peter Perfect. It is the earlier you take action, and taking some action will mean that you are financially free or in a much better financial position over the long term. Yeah, it's so frustrating when we hear people go, the market will drop another 5%. I'm like, it never is the bottom of the market. It was the bottom of the market. You have no idea when the bottom of the market's going to be. And it's really, yeah, we're trying to hammer into people to take action. And again, this doesn't have to be go out and buy stocks, go out and buy houses. This could be restructuring your mortgage now, means that you're better off in 2 years, and then you might be in a position to, purchase another asset or invest in stocks or something. But taking action now is much better than putting your head in the sand.
Yep. Cool. So when we talk about investing into the share market each year, the share market goes up. And as we learned last year, as a good reminder, it also goes down. But it can turn people off the share market quite quickly. So it's really helpful to have a perspective of what happens over long periods of time. So the S&P 500 is the top 500 companies in the US, but obviously we've got the NZX50. There's the Australian index. There's lots of different indexes around the world where you can invest your money. The same principles apply across all of them. So 40 of the last 50 years, the S&P 500 has gone up in value. So you ended up with more money than what you started with. The average annualized return is 10.9%. 18 of the 50 years, so 36% of the time, you have got more than a 20% gain in that year. And only 3 out of the 50 years, 6% of the time, there's been a loss of more than 20%. So investing is going to put you in a good position long term. It's just if you have short-term goals for your money, like the crypto bros who put their money in to buy their first home and then they couldn't buy it because the money had dropped 2/3, or the same with the share market, whatever it might be. Short-term goals, this can hurt you a lot. If you're a long-term diversified investor, the numbers speak for themselves.
Yeah, and it's always about time in the market versus time in the market, whether that is the share market or the property market. And you saw that with the different investing styles. Ashley Action, who just put her money in on the first day of the year, had more time in the market, and it was more time over 20 odd years to accumulate more wealth.
Cool. So with these presentations, we do a quick plug of like how we can help, but don't worry, we keep it pretty light because we know it can be a bit overkill. So if you are thinking, I need help with my situation, I need a financial plan, I need to talk about where I should be investing my money, what's going on in my situation, talk about KiwiSaver insurance. We offer like a 30-minute chat, which if you scan that QR code, which probably won't work because everybody's in the same room, but you can just reach out, book a time and talk about your situation. A lot of people go like, what is a financial plan? Which is probably like, a financial plan is not a budget. A budget's really important to know where your money's going. But rather, if we jump onto the next slide. So a financial plan is pretty much going, firstly, not where should you invest your money, but what are your goals? Are you trying to retire early? Are you trying to get onto the property ladder? Are you trying to help kids into first homes, create a bit of a passive income? get long-term capital gains. What's important to you? So we start with your goals, then we work out through your budget. We work what are the right investment decisions off the back of it. And then as you can see, like our financial planning software allows us to project out multiple situations to go, if we have a plan and stick to it over a long period of time, where will we end up?
Cool. So the thing that everyone's sort of, the biggest question on everyone's mind who's got a property at the moment is what should I do with my property? What should I do with the mortgages? Now, counterintuitively, even though I'm a mortgage broker, I am always telling people to pay down the debt on their owner-occupied property as quick as they can. If you've got an investment property and an owner-occupied property, be hammering the owner-occupied debt first. That is the one that's, probably not interest deductible, the one that's just going to sort of eat up any usable LVR that you could then potentially leverage again. So really focus on that owner-occupied debt. If it's not sustainable at the current interest rates or where you're going to roll off to, maybe think about restructuring the loans. Maybe some of it goes on interest only, maybe you extend the loan terms, something like that. But if you can, continue to pay down that owner-occupied debt as soon as possible. If you've got a property portfolio, now might be the time to actually review it and think, okay, what does the mix of houses or properties in this portfolio look like? What is the tax treatment I'm getting off them? Are some of them growth properties versus yield properties? Do I actually maybe need to recycle some of those properties and get rid of an in-situ investment property and pick up a new build investment property because I'll get better tax treatment? You can have a higher LVR on these properties when you go to borrow and these sorts of things. So just review the property portfolio, maybe sit down with an accountant or a mortgage broker or both and just have that discussion. Reviewing your loan structure. I sort of mentioned it before in terms of paying down your owner-occupied debt, but you may want to look at extending the loan term if the payments are too much, maybe putting some of the loan or all of the loan on interest only if you're really stressed in terms of the cash flow into the house. Think about the fixed terms of your loan, when they come off, when should you be refixing and what should that look like? We had some pricing from ASB the other day come out where the 4 and the 5 year rates are lower than the 1 and 2 year rates. And I think maybe they might be lower than the 3 year rate as well. So you're starting to see some really skewed pricing in the market and people may be thinking, oh, I should fix for 5 years now because it'll give me some stability. Actually, you're probably likely to see rates come down further over the next 2 years that'll make that 5 year or 4 year rate look a little bit worse. So again, review the loan structure, have a chat to a mortgage broker or an expert about this. They'll be able to give you some personalized advice. If you are looking at buying a house soon, and we've got a lot of first home buyers who are looking to get into the market at the moment because, hey, prices are down sort of 10, 18%, and houses aren't selling at auction, they're selling by negotiation, which is so much easier for a first home buyer, so much less costly and stressful. Just make sure your deposit isn't at risk. So James sort of cracked the joke before about, the crypto bros having their deposit money in crypto. But, that's probably the extreme version. Actually, you've got to think about your KiwiSaver fund. Is it in a growth fund? Is it in a cash fund? Is it in a balance fund? What is likely to drop? What is my time frame for buying? Do I need to pull it all into cash to make sure that I've got $80,000 in my KiwiSaver today, and I know I'm going to have a similar amount in 3 months when I go to buy? So few things to consider there. But again, what I would probably say is have a chat to an expert about each of these so you can get some personalized advice. Cool. So if you are struggling or if you're looking at the interest rate rises and going, oh, crap, you know what? Like, I'm going to be rolling off a low interest rate onto a high interest rate, and that's going to really hurt. Here are some things you can do to sort of look at decreasing that cash flow impact and increase the cash that you've got in the household. So extending the loan term out, back out to maybe 30 years or 25 years or something like that, will decrease the minimum repayment that you have to make on a weekly, fortnightly basis, these sorts of things. If you extend the loan term back out, generally speaking, once you're past the sort of hurt period, you could increase the loan repayments again to try and catch up on some of those payments that were decreased, and maybe try and just, again, really attack that owner-occupied debt and pay it down quickly. If you're thinking, this ain't looking good, I'm really going to struggle here, you might want to put all of the loans on interest only. So what that will do will mean that you're not paying any of the principal off and that you are just paying interest. This will mean that after the interest only period ends, you've got less time to sort of repay the loans. Your repayments might be a bit higher, but this could be a way of reducing the cash flow impact of the higher interest rates and increasing the cash in the household. The maximum term for interest only is 3 years for owner occupied and 5 years for investment property. But you just need to have a chat to your banker or mortgage broker sooner rather than later. Because if you roll off the interest rates and effectively you can't afford the amount of debt you've got, maybe you go into default on the loan, you miss a payment or something like that, it really narrows down the amount of options that the bank has to try and fix the situation. The next thing is equity release. So if you've got a bit of equity in the property and you're sitting on some high credit card debt, a GE card that maybe rolled off its interest only period or something like that, you can look at shifting the high interest debt and putting it on the mortgage. So you may want to just consider the term of the debt. If you stretch it out over 30 years, you'll probably pay more interest over time, but it will bring the minimum repayment down, and in some instances mean that you're paying off more principal and less interest. A really sort of easy way with that debt consolidation to just reduce the cash flow pressure in the house. The next piece, dollar for dollar refinancing. So dollar for dollar refinancing is where you are effectively refinancing from one bank to another bank or from one lender to another lender or bank. A lot of people think that if you have less than 80% loan to value ratio, you are stuck at your bank. That is not the case. So let's say you've got an 85% LVR. So you've got $1 million property and an $850,000 loan against it. That loan to value ratio is exempt from LVR restrictions, which means you can actually refinance from one bank to another. Now, why would you do this? Different banks treat over 80% loans differently. Some have an upfront fee, some have an amount that they just put on the loan, some have a higher interest rate or a low equity margin. So it means that actually the way that the over 80% loan is treated might be more favorable for the cash flow. The other reason, if you're dollar for dollar refinancing, you may get some cash back or something like that. We've got an instance where some customers got, I think, $10,000, $12,000 and were able to utilize those funds to actually, do up the home a bit and save some interest cost.
Should be important to touch on here as well, especially before we go into the non-bank lender slide. None of these things are ideal. So we don't really, if unless you are in a very stressful situation, really struggling, the first thing you would do, obvious thing to do, is budget better, pull back, make sure you can try and keep your mortgage repayments the same. But all of those options are available if you're in a bit of strife.
Yeah. The other thing to look at, if you've got a property portfolio, maybe you are in a bit of a sort of sticky situation, is the non-bank lender space. Now, non-bank lenders in the past have had a pretty sort of bad reputation. Look, they're not Hell's Angels finance. They do have pretty competitive rates, especially Resimac, much more flexible terms. At Resimac, you can go 80% loan to value ratio across your entire property portfolio, whereas you might be restricted to 60% at a normal bank. They've got a lot of different things they can do, a lot of different flexible credit policy, which might mean you save your position, you don't have to sell a house. Cool. So we are starting to run out of time. So what I'm going to do is just quickly run through a case study just to illustrate, again, having a chat to an expert may mean that you don't have to sell your houses or can get you out of a pretty sticky situation. So we had some customers come to us. Average age of the customer is 32 years old. They were sisters, about $90,000 salary each, 1.24 million of debt. Now, these sisters had 2 investment properties on the North Shore in Auckland. They weren't living in these properties. They were both separately renting with their partners. They were rolling off their interest only period at Westpac, and they were also rolling off onto much higher interest rates. When they went to the bank effectively came back to them and said, look, you only get one round of interest only. So you get no more interest only. And their banker actually forgot to fix their interest rates before a rate hike. So they're a little bit pissed off about that as well. They came to us, and effectively the banker had said to them, you've got to sell a house, otherwise you're going to lose both houses, or they were going to have to top up $25,000 per year just to be able to keep the house. So they came to us for a second opinion. First of all, before I run through the solution, the bad advice they were given from Westpac was actually that they had maxed out their interest only term. You can reapply for interest only after a 5-year period on an investment property. It's just a full application. So the banker got that wrong. And then also not fixing their rates sort of actually ended up costing them quite a bit in terms of interest. So our solution that we proposed was we refinance all of the loans to KiwiBank. The reason we went to KiwiBank is that they will lock interest rates up front, which means, if the application takes 3 weeks to get approved, you're not at an interest rate risk for 3 weeks. You can lock it when you start the application. We go back on interest only for 5 years. They're going to get a 1% cash back. So what we recommended was that they take that 1% cash back, utilize that to bring one of their houses up to healthy home standard and to rent that property to Kāinga Ora. The reason we wanted them to rent that property to Kāinga Ora is that even though it's an existing in-situ investment property, if you're renting to KO, it means that you'll be interest deductible available for the loans. So better tax treatment means it shrinks their cash flow down. So all of that effectively added up to, instead of having to sell a house, they only had to top up $30 a week each extra to be able to keep both of them. So a really good outcome for the customers. And again, what I'm trying to illustrate is you don't have to have 2 investment properties or this, that, or the other. It's just, if you get the right advice, you can be in a much better situation.
Cool. And so with where interest rates are at, and I want to jump to Q&A, so we'll keep this really quick. Pretty much interest rates are around 7%. If you have a mortgage and any investments outside of your home, you're wanting to be thinking, can I get better than a 6 or a 7% return? Now, a lot of people think, well, of course I can. Like my Sharesies account or my portfolio is making a return. You've got to take into account all of the costs associated. So transactions, fees, tax, inflation will result in you ending up with a substantially lower return than just focusing on paying off your mortgage. It ain't sexy, just focusing on paying off debt. It's fun to tell you about your good wins on the weekend, but it's just not mathematically the right thing for you to do.
Yeah. Cool. So what we might do is use this as sort of the last slide, and then we might jump into Q&A, just because we're going to end up running right up to the time here. So effectively, what we wanted to point out with this slide is just that, look, we know over the long term, the New Zealand property market sort of runs around that 5% growth rate per annum. So although the market has come back a bit, and yeah, it's dropped in different regions and this sort of stuff, and 18% in Auckland and maybe less in Dunedin and that sort of thing, actually, it's still one of the fundamental sort of things with property is the ability to leverage and to multiply the amount of return you're going to get off your investment. So again, yeah, I know it's doom and gloom out there, but actually the market's at a discount. So if you can afford it, now might be the time to sort of really put the pedal down and think about, do I actually go out and make a move now?